When people hear the word invasion, they think about politics and conflict. But behind every major geopolitical decision is something just as powerful: economics. Today, we're examining a hypothetical scenario, often discussed during the presidency of Donald Trump. What would happen to Venezuela's economy if the United States intervened militarily, and what potential economic advantages or risks could that create for the United States? This is not about taking sides. This is about understanding money, markets, and economic consequences. Venezuela's economic context. To understand the impact, we need context. Venezuela holds some of the largest proven oil reserves in the world. Yet for years, its economy has been under severe strain due to hyperinflation, currency collapse, capital controls, declining oil production, international sanctions and isolation. Oil historically accounted for the vast majority of Venezuela's export revenue. As production collapsed, government income fell, imports declined, and living standards dropped sharply. This means Venezuela's economy is extremely sensitive to any major external shock, including military intervention. In the short term, a U.S. military intervention would likely trigger economic shock. Possible immediate effects include currency depreciation, capital flight as investors exit, disruption of trade and logistics, reduced consumer and business confidence. Banks often tighten lending during uncertainty. Businesses delay investment. Households cut spending. In simple terms, economic activity would likely contract further at first. Financial markets generally react negatively to instability, even if long-term outcomes later improve. However, economic history shows that major political transitions sometimes lead to structural resets. If an intervention resulted in a change in leadership, market-oriented reforms, reduced capital controls, re-entry into global financial systems, then Venezuela could eventually attract foreign direct investment, especially in energy, infrastructure, transportation. Oil production could be modernized with new capital and expertise. Exports could recover gradually. Government revenue could stabilize. This would not be immediate rebuilding. Oil capacity could take years. But clarity and rule stability are powerful drivers of investment. From a purely economic perspective, potential advantages could include energy market stability. Increased regional oil output can help reduce global supply shocks. Corporate investment opportunities. U.S. energy and infrastructure firms could gain access to new projects, creating revenue and jobs. Trade and influence. Economic engagement often leads to stronger trade relationships and regional influence. Inflation management. More predictable energy prices can help ease cost pressures across the economy. However, it's important to note the U.S. is already a major energy producer. Venezuela alone would not transform the U.S. economy, but it could reduce risk at the margins. No economic action comes without trade-offs. Potential risks include high military and reconstruction costs, investor uncertainty during transition, geopolitical backlash, short-term oil price spikes due to instability. Markets often react first to risk, not long-term potential. From a financial perspective, this would be a high-risk, long-timeline scenario with uncertain returns. Venezuela's economy would likely suffer short-term disruption from any military intervention. Long-term recovery would depend on stability, reforms, and investment. The United States could see strategic and economic benefits, mainly through energy security and reduced volatility, but with significant risks and costs. This is why global events are never just political. They are deeply economic. If you want clear, Neutral explanations of how global decisions affect money, markets, and economies subscribe to Wealth Explained. Because understanding wealth starts with understanding how the world really works.